This week, Bitcoin's down 8, Bitmine is down 20. What's happening here?
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is...
What do you think? 150 by the end of the year? What do you think's happening here?
I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks.
In this episode, we're going to unpack their thoughts on the recent crypto pullback, the structural forces pressuring digital assets, the rise of crypto treasury companies, and where leaders like Saylor think Bitcoin is headed next. If you want a sharp, expert-level understanding of the current market and its long-term opportunity, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Can crypto treasuries, like yours, for example, can they trade as well or in tandem with a cryptocurrency itself, or does one have to trade at the expense of the other? If I'm going to see money flow into Bitcoin or crypto treasuries, wouldn't it then come out of the actual pure play coin itself?
Not exactly, Scott. For instance, when Bitmine has shareholders and institutional capital comes in, and JP Morgan, Invesco, BlackRock are buying big stakes, then that capital is then used to buy Ethereum. So it's actually going back into the ecosystem, but then it's going into a vehicle like Bitmine that's actually a permanent holder. Bitmine owns 3.5 million Ethereum, more than 2.9% of the supply, but now that is not going to be subject to liquidations because there's no leverage used to hold that Ethereum. And then at some point, that 3.6 million or 3.5 million Ethereum is going to be staked and then generate nearly $400 million in net income. Well, that can create returns for shareholders. So in a way, a crypto treasury is actually a pretty attractive equity because there's an income component, plus there's, of course, that ability to grow your Ethereum holdings per share.
But what if crypto treasuries become more favored than crypto itself? There's no negative impact for either the way that Ether or Bitcoin would trade if just more money floods towards the treasury part of this story?
Well, one, it's a conduit because, as you know, equity managers, many of them, the 4,000, can't own crypto directly. So they have to get exposure to Ethereum by buying a stock like Bitmine. And Bitmine is the 438th largest stock in America today. It's not that different than if someone wanted to have exposure to energy. They can buy oil and trade a commodity, or they can take like oil barrels at home, or they can buy an oil-related stock, either a major or something in the supply chain. That's what crypto treasuries are, is essentially an asset class that gives you direct exposure to the crypto asset.
All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be after what we've seen this week?
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAII went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. In fact, maybe over 7,000 by the end of the month.
According to Lee, the market is still digesting the massive April 10th deleveraging event, the biggest in crypto history. This wasn't just volatility, it damaged market maker balance sheets. Some firms are still raising capital today, and those fundraising efforts create sell-side pressure every time crypto attempts to rally. This, Lee explains, is why crypto has lagged equities since October. It's not fundamental weakness, it's structural cleanup.
We all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital at 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you, and what does the downside in this moment look like to you?
I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation. A lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be.
In terms of the way your fund is structured and the debt that you've taken out to effectively buy Bitcoin, what are the trigger points, just so people understand the full risks involved for you, in terms of some of these preferreds and other things, in terms of where Bitcoin needs to lie, either on the low end?
Well, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point.
I was curious if you could comment on something we heard from Cathie Wood last week. She has a target, I think by 2030, she had it at $1.5 million a coin, and recently suggested it might actually be closer to a 1.2, which is still pretty remarkable unto itself. And yet, when she explained her new rationale, it was actually that stablecoins, the sort of emergence of stablecoins and the growth of those coins being used for transactions, she argued could ultimately crowd out some of the use case for Bitcoin. What did you think when she said that?
I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof of stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stablecoins, tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stablecoins are going to go from hundreds of billions to trillions of dollars, but it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
But no, that's interesting, though, in terms of buying today at $95,364 versus buying 2 or 3 weeks ago. You're saying you were buying at both. If you were looking over the last year, sort of at your average, do you weight the buying based on trading?
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin. The point that I would make for any investor is, if you have money you don't need for 4 years or longer, and if you don't trust anybody, you want no counterparties, you just want to own a piece of the global digital economy, you buy Bitcoin. It's the commodity. If you're an equity investor and you want to bet on digital credit and you want to bet on digital capital and you want some amplification, you buy an equity like MSTR. Right. If you have money for less than 4 years and you're an investor and your time frame is 12 weeks, you should buy the digital credit. For example, the credit instruments we've created have stripped the volatility off of Bitcoin. Bitcoin's vol is like 45 on a trailing 30-day average. We have instruments at 28, 21, 15, and Stretch is a vol of 8. So if what you want is like a serious yield, you want the credit.